And now moving on to the top story this hour. Well, the US government is currently engaged in what could be one of the most costly games of hawk and dove in history. If Democrats and Republicans do not agree to allow the US to borrow more, or in their language, raise the debt ceiling, the world's biggest economy will default on its $31.4 trillion debt. They have to reach an agreement by the ominous sounding X date of June 1. But even after a series of fruitless meetings between the House Speaker and US President, Kevin McCarthy is rather optimistic about a deal before the deadline of June 1. And Joe Biden says that a default is completely off the table. But what if they don't? While joining us now to discuss this and more and other eventualities, we now have Anurag Singh, who's the managing partner, Ansett Capital, and Peter Cardillo, chief market economist, Spartan Capital Securities, LLC. Let me first come to you, Peter. Now, this is a crisis of sorts happening at a time when growth forecast for the country has been marked down several times. Inflation has been a concern. So experts are claiming that the country could default on its debts. Janet Yellen has stated so. And the urgency has been highlighted by Kevin McCarthy, who's the speaker. But he says that debt ceiling talks were productive, but still there is a no deal. Although one would understand that time is of essence here, and yet it seems maybe it's not, given how it's been handled by the government. What's your take on the overall issue and how it's been handled?
For starters, I think there's no chance that the United States is going to default. And if you just look at the markets, obviously they're telling you that this is just a saga. And it's happened in the past. Now, if there was any outside chance that the U.S. would default on its debt, certainly the markets would not be behaving as they are. Stocks would probably be down anywhere from 15 to 20%. The price of gold would probably be close to maybe $3,000 or $5,000. The dollar would be losing at least 20 to 30% of its value, and yields would be skyrocketing. And that's not happening because no one really believes that the default is going to happen. Now, what will happen is that there will be an accord. We could go down right to the wireless, so to speak, and perhaps Janet Yellen is going to have to pull her hair out by deciding what bills to pay first. But an agreement will be reached, and there'll be something in there for the Republicans and something for the Democrats. Look, it's a political theater right now.
Right, Peter, very rightly said it's a political theater right now. And of course, I agree with you. In fact, the several economists also that we've spoken over the past few days also say that there will be a deal. I was actually speaking about overall how the issue has been handled. Why are we waiting for the last minute, for a deal to be arrived at? And on this point, I want to bring in Anurag here. Anurag, even if the stock market is seeming positive and is reflecting that there is no need to worry, why aren't markets really showing the urgency here? What is your take on this overall issue?
So Sumita, I think Peter rightly laid out the landscape that we have, right? But ultimately, the market also knows that in Washington, the way of doing deals is on the 11th hour. And that has been the norm for the last few years. So ultimately, a deal will get done, but it will happen at the 11th hour. There is, may I also add, we understand if ever there was a risk of, I wouldn't say default, look, because I think Peter also said you can prioritize payments. There is just about $65 billion of, debt payments that go out. You can prioritize that. There is enough money in the treasury that comes every month. It's about 300 to 400 billion every month. So government can manage that, right? But ultimately, eventually a deal will have to get done. So first of all, don't hold your breath on the 1st of June, because that's a date which is just kind of made up. But that's an approximation. But ultimately, the debts are being honored. But eventually, market knows that the larger game
that it could happen later than that.
Yeah. So the government can, as they, Madam Yellen also said, that ultimately we can scrape by till mid of June as well, right? Because then you can say only I'll pay the the debt liabilities and I'll defer the other liability, and that has happened, right? Because what happens in a government shutdown? Government, it has happened in the past that government hasn't paid its salaries and other benefits for about just a couple of months, and then it came back right hand, right? So that has happened. So ultimately default is off the table, but yes, agreement has to be reached, and there will be spending cuts which market loves eventually, Rook, because this fiscal spending can't also continue forever. So I think that's the balance. Market eventually knows the real battle lies with the Fed and how they behave, and that's where I think the market is focused on, and they're at a level where they are. I would say probably they are overshooting themselves, but I think probably they're counting that Fed is probably done and inflation will be kind of contained in due course of time. Samita.
All right. So, Anurag, I have one more question for you before we go back to Peter. Could it be said that it's an opportunity for the investors to, in fact, pull out of cyclicals and put their money in growth stocks?
I won't say that, Sumita, because now for this you need to take a stance. One, first of all, define what is growth stocks. People say these, these Apples and Microsofts and Facebooks and Teslas of the world are no longer growth stocks. They are in a fairly mature, maybe barring Tesla, everybody else is kind of in a fairly mature market. So one, define growth. But even then, I think one is the sectoral leadership is likely to change. These markets, these stocks have been leading the market for the past 15 years. The money will never be so cheap, or at least in the near future is unlikely to be as cheap, at least on 0%. So maybe the leadership would change. And the third is, again, it depends where you stand. If you think inflation is done and it will come down very obediently back to 2% within 1.5 years, and it will obey the Fed, well, then of course you are right. But if you're on the other camp, and I would say that's where I am, where I would say Fed might pause this time, but they might need to come back again after 3 months and repeat Paul Volcker 2. And then you need to be really scared and stay out of the market. It's a bet, I may be wrong, but you need to be right to make money on this. And I stand on the other side, Sumita.
Right. So you stand on the other side, and of course, it's a bet that you need to wait and watch out for. But Peter, coming back to you, if the real deadline is June 1, then the X date practically has to be sooner than June 1 because, there are certain processes, certain number of days to also finish the pending processes. And if a fall, in the eventuality that if a deal doesn't get through, what would a fall really look like? Although that's off the table completely, is what everybody's been saying. You're also holding that opinion.
Yeah, well, let's assume a deal doesn't
Peter.
get done, or it does get done, let's say, within the next couple of days. Obviously, it has to be passed by both chambers, and of course, that could take some time. And with the Memorial Day holiday approaching, that means that they would have to call the members of both houses back to Washington. And obviously, it would get passed, and I think that it will be signed before June 1st. Now, let's assume that a deal is reached, and it takes time to get it through the legislative process. Then, the fact that a deal is reached, that would simply mean that technically, we would be in default, but we really wouldn't be in default because Janet Yellen herself said that there is enough of money that we could pay our bills at least until the 3rd or 4th week of June. So bottom line is that even if there was a technical default, it would not be meaningful, and the markets would know that. But my guess is that we'll get a deal done within the next couple of days. It'll be quickly rushed to the legislature branches, where then it would be signed by Biden before the deadline.
Right, Peter. There's also speculation that in the event that both the sides are not able to reach a deal, the U.S. president will evoke the 14th Amendment, which will allow him to surpass a debt ceiling without needing any approval. Is that a possibility that you see?
I don't think so, because there are legal complications involved. It probably would be challenged in the courts, and that would take time, and everyone knows that. And I think Biden himself knows that. He said that it's an option, but he also said it's not the right option because it would meet challenges. And then, if that were to happen, then yeah, you could see a default, and that would be very, very negative for the market. So I don't think that's the option that they're going to go, that they're going to take. But I do think that, as a colleague said, there will be spending cuts. The Republicans will get not all of what they want; they will get some of what they want, and so will the Democrats. So there'll be a bipartisan agreement.
Right, you're saying that there will be a bipartisan agreement. Last few thoughts, Anurag. We want to understand from you, what are really investors at this point in time thinking? Are they shifting to, are they looking at other markets? What really are the options that they're looking at? Although everybody's been saying that, the event of of the deal not happening is completely off the charts.
Yeah, sure. So I think, Sweta, we should forget about this debt ceiling. This will pass eventually. Politicians love the limelight. I think they will share their moment in the sun, and then eventually it will be past that, right? But ultimately, I think the big point is where, if you look at a global landscape, where is the future growth lying? We see Japan emerging as an important, interesting destination. Buffett validated that as well, and there are other companies moving there. Maybe it is having a resurgence after 25, 30 years. But other than that, I think European Union, the growth is muted, just about flat. So I think US, we pretty much wait for this recession, which seems to be 6 months away all the time. But the point is, it will keep the markets guessing. And I think the kind of growth we've had for the last 2-3 years, and look at that in the last 15 years, if you put that in perspective, the zero money policy, ultimately it has begun to bite both European Union and United States in terms of high inflation. And I think if you give a choice to Chair Powell, if you would take persistently high inflation or a recession, I think he would pick recession any day. So I think, Anisha, we would be cautious. The money is lying on the sidelines, about $5 to $6 trillion of cash waiting on the sidelines. Aside of that, I think investors have turned cautious. Third point, Anisha, is that if you're getting about 4 to 5% returns, in US market, depending on the duration, you are from 1 month to 10 years, you're getting close to, that fixed income return without taking any risk. Why would anybody want to stay in the market? I would, for our preference, we are rolling into the shorter term maturity deposits, and we're getting considerable return without taking much risk. So we are cautious on the sidelines. That coupled with the fact that the markets are really not cheap, right? They're discounting in the best case scenario. So we would be cautious. I think so. Manage your portfolio allocation well. Don't overbet on equities would be my message, Sumita.
All right, Anurag, those are the final words for you. Don't overbet on equities. And Anurag, Peter, thank you very much for joining us here on India Tonight. It was lovely having you and chatting about the US debt ceiling showdown. We'll